Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Preferred stock ETFs offer a unique middle ground for investors looking for higher yields without diving into the volatility of common stocks. These funds bundle preferred shares, hybrid securities with bond-like fixed payments, and equity-like features into a single, easy-to-trade package. They've gained traction as a way to boost income while keeping risk in check, especially in uncertain markets. In this video, we'll break down how preferred stock ETFs work, their advantages, and what to watch out for. You'll also find a curated list of top-performing funds to consider for your portfolio. Whether you're after steady dividends or diversification, these ETFs could be worth a closer look. What are preferred stock ETFs? Preferred stock ETFs bundle together preferred shares, a type of investment that sits between stocks and bonds, into a single tradable fund. Unlike common stocks, preferred shares act more like fixed income securities with regular dividend payments, while still offering some equity-like benefits. These ETFs provide instant diversification across multiple issuers, making them a popular choice for income-focused investors who want stability without sacrificing yield. Key features of preferred stock ETFs. Fixed dividends. Preferred shares typically pay set dividends at a predetermined rate, similar to bonds. These dividends often take priority over common stock payouts. Hybrid nature. They combine features of both stocks, potential for appreciation, and bonds, steady income, making them less volatile than common stocks, but more flexible than corporate bonds. Priority in payouts. If a company runs into trouble, preferred shareholders get paid before common stockholders, though still after bondholders. Callable features. Many preferred shares can be called back by the issuer after a set period, which may impact long-term returns. How they compare to common stock ETFs and bonds. Preferred stock ETFs differ from their common stock counterparts in a few key ways. Common stock ETFs track regular shares, where returns rely on price growth and variable dividends. Preferred ETFs, on the other hand, focus on fixed payouts and often show less price fluctuation. Compared to bonds, preferred ETFs offer higher yields and the chance for modest price gains, but they come with more risk. Bonds have stricter repayment guarantees, while preferred shares can be more sensitive to interest rate changes and company performance. Think of them as the middle ground, more income than common stocks, more flexibility than bonds. This balance makes preferred stock ETFs a smart pick for those who want reliable cash flow without locking into lower-yielding fixed income. Benefits of investing in preferred stock ETFs. Preferred stock ETFs aren't just another income tool. They're a strategic way to balance yield, risk, and tax efficiency. If you're tired of the roller coaster ride of common stocks or the meager payouts from bonds, these funds might be the fix. Let's unpack why they're worth a spot in your portfolio. Higher dividend yields and income stability. Preferred stock ETFs are built for income. Unlike common stocks, where dividends can change or disappear, preferred shares lock in fixed payouts. That means predictable cash flow, often at higher rates than bonds or common stock ETFs. For example, the iShares Preferred and Income Securities ETF, PFF, has consistently delivered yields between 5 to 6%, while the S&P 500 averages under 2%. Dividends are usually paid quarterly, making them ideal for retirees or anyone needing regular income. Since these dividends take priority over common stock payouts, you're first in line for payments, even if a company hits rough patches. Lower volatility and risk mitigation. Preferred stock ETFs act like a shock absorber for your portfolio. They're less jumpy than common stocks because their prices are tied more to interest rates than corporate earnings drama. Here's how they smooth things out. During the 2020 market crash, common stocks dropped 34%, while preferred stock ETFs like PFF fell only 20% and recovered dividends faster. Their bond-like features, fixed dividends, no voting rights, keep them steadier, though they're not immune to interest rate swings. This makes them a smart hedge when markets get shaky. Tax advantages and efficient income streams. Some preferred stock ETFs offer a tax perk, qualified dividend treatment. If held in a taxable account, dividends may be taxed at the lower long-term capital gains rate, 15 to 20%, instead of ordinary income rates, up to 37%. For example, ETFs holding U.S. corporate preferred shares like PFF or PGX often qualify for this benefit. REIT or foreign preferred stock ETFs usually don't, so check the fund's tax docs before buying. This tax efficiency can add up, especially for high earners. Combine it with the steadier yields, and you've got a reliable income stream that keeps more money in your pocket. Risks and considerations. Preferred stock ETFs aren't flawless. While they offer stability and higher yields, they come with risks that could trip up unprepared investors. Understanding these pitfalls helps you make smarter choices and avoid nasty surprises. Interest rate sensitivity and its impact. Preferred shares act like long-duration bonds, meaning they react sharply to interest rate changes. When rates rise, their fixed dividends look less attractive, pushing prices down. Here's how it plays out. A 1% rate hike could drop preferred ETF prices by 5 to 10%, erasing months of dividend gains. Funds with longer duration holdings, like PFF, get hit harder than those with shorter terms, such as PFXF. Tip: pair preferred ETFs with floating rate funds or short duration bonds to offset rate risk. That covers the first group of preferred stock ETFs worth considering. In Part 2, we'll dive into more options and tips to help you choose the right fund for your goals. Stay tuned for Part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.